Greetings, everybody. Welcome to Liberty Call. I am Raymond Dahlman, your humble host. Today is Wednesday, June 14th, 2023. Hope everybody's having a fantastical day out there. It is finally a sunny day here in Colorado. We have a few clouds, but the sun is shining, and it is pretty nice. But we had a Fed decision today. Everyone was on pins and needles, all excited about what the Fed was going to do, and they didn't do anything. They basically held rates as is. So I'll have some more details as we go along, but not to say that they're probably not going to raise rates at the next meeting, which is July 25th, or the September meeting. But for now, we're in a holding pattern. So, all right. Well, if it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. Please give me some thumbs up, likes, shares, subscribes, follows, all that good stuff. And let's go ahead and jump into the numbers for today. The Dow Jones was down 0.68%. 232 points, closed at 33,979. It really took a dump after the Fed announcement. SP 500 was flat, up 0.05%, closed at 4371. NASDAQ was up 0.39%, closed at 13,626. The VIX was down 5% today. It's currently at 1388. Canada was up 0.12. Brazil was up 1.54%. Mexico was up 1.05%. Over in Germany, they were up 0.49%. The UK was up 0.1%. France was up 0.52%. Netherlands was up 0.48%. Spain up 1.06%. Italy up 0.88%. Switzerland down 0.43%. And Portugal up 0.13%. Both Russian exchanges were green. MOEX was up 0.29%. And the RTSI was up 0.5%. Over in Asia, starting out with the Nikkei in Japan, it was up 1.47%. Australia up 0.32%. New Zealand down 0.29%. Headed to China, the Shanghai was down 0.14%. The Shenzhen Component up 0.26%. China A50 up 0.14%. DJ Shanghai flat down 0.03%. Hang Seng down 0.58%. And the Taiwan weighted up 0.13% for the day. All right, so like I said, the markets didn't react too kindly to the Fed saying that, I guess I haven't read through all their statements, and he was on mute. I was in a meeting when he was talking earlier today, so I have to go back and see what exactly he said, but I'm sure everyone was freaking out. All right, let's go to the market recap for today. Wall Street stocks experienced a decline on Wednesday following the Federal Reserve's decision to keep U.S. interest rates unchanged. The market reacted to the central bank's new economic projections, which indicated that borrowing costs are likely to rise by another 0.5 percentage point by the end of the year. The SP 500 initially saw gains, but later traded lower as investors digested the Fed's response to a stronger than expected economy and a slower decline in inflation. The new projections added a hawkish tone to the interest rate decision, with policymakers foreseeing the benchmark overnight interest rate increasing from the current range of 5 to 5.25 to a range of 5.5 to 5.75 by year end. Investors expressed concerns over the possibility of at least 2 more rate hikes without any rate cuts before the end of the year. The sentiment led to a sell-off in the market as they reacted to the potential impact of higher borrowing costs. Sam Stovall, chief investment strategist at CFRA Research, highlighted this concern. Earlier in the day, the release of data showing larger than expected drop in U.S. producer prices in May contributed to the perception that inflation was cooling. However, the Fed's projections still indicate a willingness to raise rates. NASDAQ dropped 0.67% to 13,482, while the Dow was affected by United Health Group's warning of an increased medical costs in the second quarter. United Health stocks tumbled 7.6%, weighing on the S&P 500 Health Sector Index, which fell 1.3% today. The SP 500 Managed Healthcare Index also experienced a significant decline of 8.1% due to its lowest level since February of 22. In contrast, shares of hospital operators, Universal Health Services, and HCA saw gains. The overall stock market had been on an upward trajectory in recent weeks, reaching 14-month highs. That was driven by signs of economic resilience, a better than expected earnings season, and the belief that interest rates were nearing their peak. The SP 500 has risen 13% this year, while the NASDAQ is up 29%, but it was down quite a bit last year. Although large cap technology stocks have been the main contributors to the market's gains this year, economically sensitive small cap shares, as well as the material and banking sectors, have also joined the rally in recent times. On the New York Stock Exchange, declining issues outnumbered advancing ones, and a similar trend was observed on NASDAQ. The SP 500 recorded 40 new 52-week highs and 2 new lows, while the NASDAQ composite had 84 new highs and 52 new lows. All right. So, like I said, market didn't react real favorably to the news that the Fed was probably going to still raise rates later this year. So, not really a surprise here. I've been saying it. I mean, I would have raised. I mean, if I was the Fed chair, the rates would be probably around 6 to 7-ish at this point if I was running, but they would have been that high last year. So I would have jacked them up like Paul Volcker did back in the early 80s, and I would have squashed this inflation really fast. But the Federal Reserve has never called my phone to call me and see if I want the job, but maybe someday. All righty. Next up, Fed keeps rates steady, but forecast 2 hikes ahead of hawkish surprise. Or in a hawkish surprise. In a surprising move, the Federal Reserve decided to keep interest rates unchanged during its last meeting. However, the central bank took a more hawkish stance than anticipated by signaling the possibility of 2 more rate hikes in the near future due to persistently high inflation. The FOMC maintained its benchmark rate within the range of 5 to 5.25. This was the first time in over a year that the Fed chose to keep rates steady. However, the FOMC made it clear that further rate hikes are still on the table, projecting 2 more increases for the remainder of the year. The Fed revised its forecast for the benchmark rate, projecting a terminal rate of 5.6% by middle of 23. This was an upward adjustment from the previous forecast of 5.1% in March, indicating that 2 more hikes are likely. Market participants had expected a more modest increase of around 25% in the rate outlook. Fed Chairman Jerome Powell emphasized that future rate decisions would be made on a meeting-by-meeting basis, and no decision has been made regarding the July meeting. The more aggressive path of rate hikes reflects the FOMC's concern over inflation, which has remained persistently above the Fed's 2% target. The core personal consumption expenditures price index, the Fed's preferred inflation measure, is forecasted to reach 3.9% in 23, up from the previous forecast of 3.6. Inflation is expected to slow to 2.6 in 24, and the Fed members raised their inflation forecast for 25 to 2.2%. The labor market strength, which has contributed to wage growth and services inflation, is expected to continue. The unemployment rate is projected to decrease to 4.1% in 2023, lower than the previous estimate of 4.6. However, it is expected to rise to 4.5% in the following year. The FOMC anticipates the unemployment rate to remain steady at 4.5% in 2025. These people couldn't project inflation 3 summers ago when they printed all this money, but they know how much inflation is going to be 3 years from now, or the unemployment rate. Please, I mean, come on. The improved outlook on the labor market was reflected in the FOMC's revised economic growth estimates. GDP growth for 23 was increased to 1% from the previous of 0.4%. In 24, growth is expected to inch higher at 1.1% and further accelerate to 1.8% in 2025. The decision to keep rates steady allows the FOMC to assess the impact of previous rate hikes and the tightening of lending standards following recent banking turbulence. The Fed acknowledged the potential impacts of tighter credit conditions on economic activity, hiring, and inflation, but noted that the extent of these effects remains uncertain. All right. So the Fed doesn't know. They're so certain about unemployment that it's going to be X 3 years from now, but they're uncertain about inflation. Really? Really? Come on. All right, last article here, The Great Dollar Paradox. This comes from our friends over at Zero Hedge, written or authored by James Rickards of Daily Reckoning. All right, the concept of de-dollarization has gained significant attention across various publications and financial media outlets. It suggests that countries worldwide are preparing to move away from the US dollar as a dominant global currency. Examples of de-dollarization efforts include China's use of the yuan to pay for imported oil from Saudi Arabia and the UAE, as well as bilateral agreements between China and Brazil, Russia, and India to conduct trade using local currencies. These efforts are expected to culminate in the announcements of a new BRICS Plus currency linked to gold during the BRICS summit in late August. Despite the global push for de-dollarization, the U.S. dollar has remained strong in recent times, and this trend is expected to continue in the coming months. The reason for this apparent contradiction lies in the way currency value is measured. Dollar strength or weakness is typically measured against major currency indexes such as the DXY and the Bloomberg Dollar Index, which primarily compares the dollar to other reserve currencies. These indexes often exclude emerging market currencies, which are involved in the de-dollarization efforts. However, an alternative way to assess the strength or weakness of the dollar is by looking at the price of gold. Gold serves as a reliable measure of the dollar's value because when the price of gold is lower, the dollar is stronger and vice versa. The introduction of BRICS plus currency linked to gold could potentially impact the dollar's value, as Russia and China would have a vested interest in higher gold prices to increase the value of their new currency. This development could lead to a decline in the dollar's value. The trend of central banks increasing their gold holdings has been ongoing for over a decade, with a significant shift occurring in 2010. Traditionally, the United States held substantial gold reserves, but those holdings diminished over time as gold was used to cover trade deficits. Yeah, how much gold is in Fort Knox? I'd guess zero, but they haven't audited it in my lifetime. The composition of gold holders has also changed, with the emerging market countries such as Russia, China, Vietnam, and Mexico increasing their holdings. Many of these countries are part of the BRICS Plus currency union, which further highlights their efforts to challenge the dominance of the U.S. dollar. The first quarter of 23 witnessed record-breaking central bank gold purchases, with Singapore emerging as the largest buyer during that period. The motivations behind these gold purchases could be tied to de-dollarization, preparation for the new BRICS Plus gold-backed currency, or desire for stability amid global uncertainties. Yeah, well, the way the Fed prints money, you're losing money holding on to dollars. Nonetheless, this trend of central banks accumulating gold is undeniable, as it suggests there may be value in following their lead. As the de-dollarization movement progresses, there may still be time to consider diversifying holdings and exploring opportunities relating to the emerging BRICS Plus currency and gold-backed assets. So be careful out there, people. The dollar's falling apart, and we have no one to blame but the Federal Reserve and our politicians. They've done a fine job of destroying the country, and I give them a big thumbs up for being so awful at their jobs. So hopefully it all falls apart sooner or later, and we are freed from our tyrannical overlords. But anyways, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.